just wanted to welcome everybody today to Profits and Purpose, how capital is capitalizing recovery and resilience. This session, by the way, is made possible with the big thanks, generous contribution by my home, which is C-FAX 1070 Radio. I just wanted to take the time to thank everybody for joining in on this conversation. And I'll just quickly introduce myself before we get going. My name is Ferraby. I host the morning show at C-FAX 1070 Radio. And this is really an opportunity for those in our community to come together, to find ways to really stay positive. Before we get going, I just want to take the time to introduce our moderator who's going to guide you through this. Chris, 20 years ago, started a career on Wall Street, and it took him to Chicago, to New York, to London, to Hong Kong, now here in Victoria, lucky us. While working at the largest bank in the world, he had a front row seat to both the boom and the bust, and that unique experience shaped the way he views and manages risk. It was his move to Canada in 2012 that was an eye-opening experience, and he quickly realized that he could add value by helping clients avoid some of the cross-border mistakes that he made while founding Beacon Hill. Ladies and gentlemen, I want to introduce our moderator. He is a financial advisor with Beacon Hill Wealth Management. Will you please say hello to Chris Stooksbury? Chris, hello.
How are you? Thanks for having us. I've set the bar very low for myself, so all of our panelists are much more talented and better looking. So I'll start by introducing some of those people here. Peter Elkins is the entrepreneur in residence and founder of Esca Accelerator. He's a serial entrepreneur and has been involved in Victoria for, as long as I've been here. Owen Matthews is probably a familiar face to most of you, although he is clean shaven today, which kind of caught me off a little bit. He's an entrepreneur and investor. He's general partner at Wesley Clover and the chairman of Alacrity. He's founded 11 companies, but hey, who's counting? And also supports entrepreneurs and technologies companies throughout Western Canada. David Ferran raised his first $1 million in venture capital by age of 23. By the age of 33, he had bought his first public company. And by his 40th birthday, he had taken his first company public with an IPO on the NASDAQ exchange. Having founded 7 companies, David has worked, played, and fought with venture capital investors, private equity investors, and Wall Street analysts. Finally, last but not least, Annika Lewis is a venture capitalist at Vanedge Capital. She focuses on investments in analytical and data infrastructure projects. Prior to becoming an investor, she spent 6 years at Cap One, where she held a number of roles in both New York City and Toronto. So welcome, everyone. Thank you for being here today. I'm just going to quickly lay out the format for today's meeting. I'm going to spend about 20, 30 minutes with some questions for all of our panelists. We're then going to open it up to all of you. So if there's any questions that you'd like for us to ask, please use the chat feature. But that's kind of how we're going to set up for today. I want to leave enough time to get some good questions asked. I'll start with some big softball ones for our moderators here. But I thought we'd kick off, or use it as a jumping point, if you will, what the idea of capital-led resilience really means to you. And I thought maybe, Owen, you might want to start and give us your take on what that fancy term actually means.
Sure. I'm not necessarily sure what it means to everybody, but I know what it means to me. And I appreciate you picking on me first, Chris. That's because I'm all wound up and ready to go. So when I think about these chaotic times, and I have managed my way through a few recessions in the past. We're in a period of concern and stress, and in those times, people are looking for cash to continue, and of course other businesses are doing really well. So some of in general, our technology businesses are doing quite well. That being said, the economic prospects are it's the uncertainty that drives the concern. So as a venture capitalist, which is where I have one foot investing in technology companies, really you're looking at putting money into companies that are look like they're going to recover and increase in value post recession. So we've got a kind of chaotic time with a whole pile of government money coming in, and you're looking at a recovery, and you want to be deploying capital into opportunities that look like they're going to be recovering when things sort of return to normal. And that doesn't seem to have changed a whole lot in the past year. Money still seems to be going out the door. We're certainly making investments and looking for businesses that are that are likely on path to recovery and might be struggling for capital, and therefore might be lower cost asset. The other foot I have is in the nonprofit sector, and that's more mission driven. That's more focused on helping businesses get through this period. The sort of government grants that have been pushed out the door haven't necessarily, they certainly stave off serious problems, but they don't necessarily make you stronger into the future. So what we've been focused on at Alacrity is training Main Street businesses to do business online, to be able to attract customers in a way that maybe they didn't do previously. And our philosophy there is, yes, those are grants, yes, those are programs that help those businesses in the short term, but ultimately when they come out of this period, they're stronger afterwards. If the Main Street business comes back, then they have a new method of acquiring customers, and they have a stronger business going forward. It's not just a grant to sort of stave off the short-term pain. So definitely that to me is an important aspect of capital for resilience, but very mission-driven and very different than the sort of opportunistic VC investing. And then I would say in the market in general, the venture capitalists that we've seen, they tend to be, at least in the past 6 months, we've seen more aggressive and in a very particular way. If you are a high growth business, typically technology business, then they're trying to get the capital out quickly so that they show short-term results when they need to go raise a round in a year or 2 years for their venture funds. So we've seen very, very aggressive venture capitalists chasing those deals that look like they're high growth and will produce short-term gains. And anything that is promising but not showing traction quickly tends to not get capital. So it's kind of gone binary. High value and lots of capital available to companies that are growing quickly, and good prospects that might take 3 or 4 years aren't getting capital because they're not going to show short-term results. So that's what we've seen in the past 6 months. So if you can get the customers in the door and show the growth, then you're then there's lots of money chasing you. If you are a good prospect but you haven't quite got the traction yet, then it's harder. And people like us are looking at those deals and seeing them as good opportunities. So from my perspective, that's what we're seeing in the market, and how we see capital is helping businesses be resilient in this time. But that's just my opinion. We've got some smart people around the table, so let's ask them. Yeah,
Annika, anything to add to that?
Yeah, I would generally echo what Owen said. And I think if I think about the term, just breaking it down, capital-led resilience. So I define resilience as bouncing back after hardship and persevering, right? And so the capital-led version of that is using dollars to facilitate that. And effectively in 2020, that's sort of the thesis we've seen from the government, both in Canada, in the US, and many other countries, in terms of helping companies and individuals be resilient with capital. And I think, Owen talked a lot about kind of some of the pros and cons of that, and different ways that the government money has impacted businesses. I think to Owen's other point around kind of the binary nature of some of these, outcomes is totally true. And I think at the beginning of this pandemic, everyone was talking about and asking themselves, will this be a V-shaped recovery, a W-shaped recovery? What letter is this recovery going to look like? And now in the last few months, there's the term sort of K-shaped recovery has come about, whereby there are a lot of businesses that are benefiting and doing phenomenally well as a result of the times we're living in. And there are definitely some that are facing more challenging times. So overall, resilience in terms of bouncing back using capital is kind of how I see things.
I think that's a really great point, Annika. And when you talk about resilience, I'm going to read something that I saw on Twitter today that I thought was pretty crazy. So Amazon and Walmart's profits are up almost 100%, Target up 80%, Lowe's up 75%, Microsoft, Facebook, Apple, Google, all at record highs. 20% of small businesses have closed, and the remaining businesses are seeing revenues down on an average of 30%. So I was going to ask you, David, what are some of the sectors and industries that are being most basically disrupted, and what do you think the challenges are going to be long term?
I think the challenge is long term, and I'd like to address Owen and Annika's comments here, because they were talking about how capital is impacting companies and making them more resilient in the short term here, right? Dealing with these issues. And it's playing an important role. So I certainly respect that. I see that as capital treating the symptoms of companies that are not built to be resilient from the start. And what's happening now, I believe, is capital is being called on to come in and prop up companies that are not resilient enough to weather this storm without that infusion of additional capital. And so there's another role, a longer term role that capital can play that addresses resilience and prepares companies for times like this. And so there is a movement within the capital markets to support more companies that are moving towards stakeholder capitalism, where they're really investing in the relationships with all of their stakeholders, with the intended outcome being more internal organic resilience that would prepare them for times like this. So when you ask about what sectors do I think are being impacted and which ones might be more resilient, I would look to the companies that have invested in their relationships with their stakeholders as being inherently more resilient. And so I would look at B Corps, for example, as a sector or a class of companies that I think are just inherently more resilient. And in a broader scope, public benefit corps as being built to be more resilient. And the flow of capital towards those companies can drive that resilience in advance of things like COVID. And so that's just another shout out for capital.
Given that capital flows to where there's the greatest opportunity, Peter, are there any areas of the economy or sectors, so to speak, that you find attractive, that you think that the capital flows have not reflected the opportunities?
Yeah, so just to kind of back up on the resilience, I wanted to offer a couple solutions. So looking at it more at the micro level and what communities can do. So one of the things I've thought about a lot lately is the idea of commissioning 2 studies, and one of those studies would be around what we're importing, both federally, provincially, and regionally, and the other one is what we're exporting in consumer retail investment. And I personally believe with those 2 studies, we could connect a lot of dots and prioritize low-hanging fruit on both commercial opportunities and non-government funding. And I think we really have to move away from the administration, economy that we seem to be very much stuck in right now. And I think the other one is licensing intellectual property from other universities in other countries. And looking at a different way of attracting economic development, attract and retain, which really talks about bringing entrepreneurs to our community as opposed to employers. And I think there's a lot that want to relocate to our region. So I think the idea of looking broadly for IP and entrepreneurs is something we need to consider. And I also believe that to support all this, we really need to look at a local investment fund or a regional investment fund that's private. So we actually we're not so reliant on the government that we seem to really relied on for the last, I guess, 10 years since I've been here. For me, I think ag tech, which is obviously where Esca comes from. I think that's a real opportunity that's worth exploring. I think there's a lot of changes and a lot of opportunity in that space, especially on Vancouver Island. you know, which was very much about agriculture up until, you know, I don't know, actually some point in time, but yeah, I think ag tech.
Now, that's very interesting. Now, what are some of the things you think that we can do is not only in Canada, but even more specifically, Western Canada, Vancouver Island? What are some of the things you think that we can do to, I don't want to use the word take advantage of the opportunity here, but there's obviously a lot of government money that's been injected in the system throughout the US, Canada, Europe. I'm interested to hear what people think that we can do on the ground here to make sure that we're maximizing opportunities for local entrepreneurs and companies. So Owen, you want to touch on that?
Sure. I mean, I can relate to some of the pain that is happening in Victoria, you know, sort of more broadly in the economy. I'm fortunate that I'm on the tech side of our business, but a big part, you know, of our business is in hospitality. We own resorts around the world, and you know, if you contrast the two, you've got, you know, tech businesses in general doing quite well, and then you've got hospitality businesses that are shut down completely. So you know, I see a couple of questions posted about you know, how to get online locally, and that plays into the question you just asked. You know, we have a program that we set up to train people to get online, and you know, that was government funding, and as I said before, you know, our view of you know, investing in what's going to work long term as opposed to just, you know, covering the costs for this short term difficulty, to build resilience is to, you know, expand your business, and to do that using, you know, new methodologies. In particular, you know, inbound customers, having customers find you online and order things from you, as opposed to hoping they walk by your offices or your stores. So, you know, I get to see both the absolute shutdown of the hospitality business, which in many cases is shut down by law. So revenue goes to zero, which is pretty painful. And they absolutely need short-term subsidies just to, you know, keep people employed during that period where they're forced to shut down. And the other side, which is the tech companies, which are booming and have incredibly high values. You know, so at least I can resonate with the pain, because it's a big part of our business. It's not the part that I directly manage. So we look at the stuff that we do in tech, which I'm fortunate enough to have, you know, to be a part of and have it doing well. And we look at those tools and we try and bring them to our Main Street businesses, like our hospitality businesses. So, you know, trying to teach that digital literacy to you know, Main Street businesses, so they are more resilient when their storefront gets shut down. They can still sell their inventory. They can still find customers. They can still distribute product and take advantage of their supply chains. You know, those are really the programs that we've gone heavily into in the past little while. And there's been some great initiatives actually started here. You know, the Buy Local initiative has done really, really well. And, you know, we're working with them to try and get as many of those local businesses online and ad buying and doing all of the things that drive traffic to their online stores. And you know, that's probably you know, the best thing that we can be doing right now with those government grants, because otherwise it's just a short-term patch that maybe keeps you alive in the hopes that you recover. Our estimates on the hospitality business is it'll be 2 years before it goes back to normal, right? So, you know, are we really going to be relying on government subsidies for 2 years? I mean, that's not realistic, and nor is it right for the taxpayers to try and manage that. And you know, so, you know, we had good resilient businesses, you know, before that were, you know, hospitality businesses, and they're hurt and they take government subsidies, but that will peter out, and they're going to have to live with an overall lower base of business for a couple of years. So yeah, it's a difficult time, and the government subsidies need to be there, but they also need to, you know, we need to get weaned off them fairly soon, and we have to accept you know, a lower category of business for a little while.
Well, thank you very much for that. So Annika, question for you. So in your portfolio, what are some of the struggles that companies are dealing with right now? Obviously, you've got a bifurcation of the economy, as Owen said. You've got hotels with zero revenue and tech companies that are booming, and then kind of like everything in between. But if you had to say, what are some of the pain points or the challenges of companies that you've talked to What are they, and how can we address those for, to make them more resilient?
Yeah, I think the challenges, up until now this year and generally speaking have been in charting the path forward and kind of reliability on what that looks like, right? We're now in sort of annual budget time where companies are starting to put together their 2021 budgets and starting to think about what does the new normal mean for our business, and how do we create a budget that is reflective of that. Back in March, it was heads down, scrambling, figuring out, okay, what is the state of, all the companies in the portfolio, where do we need to step in and provide guidance or support. And, now that part is through, it's really thinking about the longer term and what things look like in this new normal. And, for some of the companies, it's about we've actually got amazing headwinds as a result of this, and how do we tailwinds rather, and how do we take advantage of the opportunities that have been posed to us. So it's different on a company by company basis, but I would say overall, the overarching theme I'm hearing is just how do we even begin to forecast and what, how do we make something reasonable and reflective of where we are right now?
It's a really good question. And David, I'd ask you, if you're an entrepreneur and you're trying to, as she said, make these budgets for 2021, and you have to look into your crystal ball, how do you think an entrepreneur should even approach that? There's so much uncertainty in the market, coming up with your ad budget or your advertising budget, marketing budget. How do you think that people are looking at that? You're muted.
Sorry about that. We deal with a lot of entrepreneurs at Torrey Project. In fact, we just graduated 19 new entrepreneurs from our boot camp last night, and they really cover a lot of different sectors. And I think that COVID is really throwing different challenges and different opportunities at the entrepreneurs we're seeing. So we have entrepreneurs who launched businesses. They were just taking off and they've literally been shut down. And in some cases, I don't know if they're going to be able to resurrect them. I mean, this might be a fatal blow to those entrepreneurs, where there's other entrepreneurs who have technologies that are very interesting and they're getting a lot of attraction and a lot of interest. So I really think it's a sector by sector issue.
Mm-hmm. Yeah, it seems to be a boom and bust for different sectors, which I'm sure is challenging. So Peter, what advice would you give an entrepreneur who's looking at 2021, somewhat nervously, maybe thinking a vaccine will be first or second quarter? How do you coach them on how to manage risk between now and then?
Yeah, that's a good question. I think I'll pass on that question. I don't have a good answer for you.
Lever up and keep some dry powder. How about you, Owen? What advice would you give? I know you speak to a lot of entrepreneurs who are probably apprehensive at best about next year. What kind of advice would you give them?
Lean burn, right? As I said, venture capital is probably not forthcoming quickly to very, very early stage businesses. So earn your right to their capital by showing you can grow. And don't come in with the mentality that you need $5 million to grow your business. Come in with the mentality that you're growing your business and you need their capital to grow. So to grow faster. Don't think you need a whole pile of money to build a great business. We're in a really unique time. When I started in venture capital, it was $20 million, for you to have a viable business. You had to build sales channels all over the world, and you had to, invent complicated, even if it was software, most of the platform, you had to build yourself. These days, it's incredibly easy to build a viable business with very little cash. So, test your product market fit. I often say, you don't have to build a product to know that you have a business. I mean, you look at things like Kickstarter and Indiegogo, people who haven't built product yet can prove that there's customer demand. So if you can prove there's customer demand and you have some minimum viable product, and the demand looks really, really strong, that's encouraging to people to come in and invest and help you grow. So there's plenty of capital on the sidelines. They're just hesitant because they don't know what's going to happen in the next year or two, unless you really have a strong growth story. So, stay lean, focus on getting the customers in the door. Don't spend a lot of time thinking complicated product and complicated features. show the demand. And if you can show the demand, then investors will come along and say, great, well, we'll help you polish the product.
Anyone have anything to add to that?
Yeah, I can add to that. I think I agree with everything Owen said. And one thing I would say I'm generally telling early stage founders when I talk to them is if you can raise capital now, go ahead and raise it. It's a very founder friendly environment right now. It's incredibly competitive on the venture side. There are more funds than there's ever been before, and deals are getting preempted. There's a lot of capital out there to be had for the good companies. And so, when founders are, asking me, should I be raising now or should I maybe wait a year and try and string myself along? We don't know what's going to happen to the macroeconomic environment in the coming year. It's very possible that things could change quickly. And so generally my philosophy and my advice to entrepreneurs has been, if you can take capital now on terms that are good, then absolutely take it.
Yeah, I think this has shown that, having dry powder on your balance sheet or being in a financial situation where your business is not over levered, the people who I think went into this crisis with that, when the whatever letter comes out, whatever it's V or W, those businesses I think are going to be able to not only recover faster, but have a competitive advantage versus others.
Yeah, I think the old classic lesson, when we get involved in businesses, we generally think about fundamentals, right? You never quite know when you're going to raise the money. So as Annika says, you definitely want the capital when it's offered. But if things go wrong and you don't have the capital, then you don't want to go out of business because you're so desperate for it. So you need fundamentals, you need sales, you need enough cash to sustain you for a period of time when you can't necessarily raise money. So you always have to think about the fundamentals. If you're wholly reliant on investors' money, no matter what, and that investors' money dries up, then you're gone. And that's not a way to run a business. If you want to grow and it makes sense to grow, you take investors' money and you grow. But you want to be able to, if you need to, cut back and survive with enough, revenue and to sustain you through a dark period. So yeah, you always have to think about fundamentals. At the same time, you take money when it makes sense for you to grow.
Yeah, and that's another challenge I would add with today's fundraising environment and with all of the capital that there is to be had. We're seeing some huge round sizes for very early stage companies. And there are dangers in that. While I tell entrepreneurs take capital now to the extent that you can and that it makes sense, don't raise too much that you're going to have an absurd valuation to catch up to in 18 to 24 months when you're raising your next round. That puts you in a tough position. It puts your investors in a tough position. And so, yeah, it's a fine song and dance and balance. But again, it all comes down to what I was talking about for 2021 and predicting, budgeting, how much am I going to need to spend in the next 18 to 24 months, and raising what it will take me to get there, not necessarily a lot more than that.
And during these uncertain times, probably a good idea for entrepreneurs to raise even more money, though, than they think they might need, because you really don't know what's around the corner.
Yeah, that's for sure. And there's obviously a record amount of money chasing not a lot of deals. And I'm sure everyone's heard, these stories about how Series A's are multiply oversubscribed, and yet there's some businesses that can't get access to capital at all. So I'm curious, Peter, what have you changed, or what have you done differently since the COVID crisis in your business, and how are you approaching it from that standpoint?
Yeah, it's a good question, Grayson. It's interesting that we're hearing a lot about venture capital, and there's a place for it, but I think Victoria's got a much bigger opportunity around the innovation and around the pre-seed side of it. We've got lots of academic institutes, we've got lots of innovators, and we've got a lot of great business people. And so what I've really realized from my experience in this ecosystem is, and which is why that question you asked was hard for me, because I haven't been thinking that way since COVID. I've really changed my approach to how we're doing things. And what I've realized is to get more innovation off the ground, which is the space I'm interested in, long before the venture capital kicks in, I've realized that we really have to consider innovators over entrepreneurs. So, I actually don't work with entrepreneurs anymore. I'm more interested in the craftspeople, the artisans, the programmers, the thought leaders, and we're running it more of a studio. So we look at it as a private equity play where we're taking the innovators and applying the business people, which we have a lot of underemployed business people in Victoria that we're paying to rapidly scale the innovation to get it ready for venture capital. So we're taking a much different approach now to how we're growing businesses. And this comes out of my experience watching angel investing as one of the co-founders of the Capital Investment Network, as well as working with entrepreneurs and advising them. I've realized that we just don't have enough entrepreneurs in Canada. We're not a country of entrepreneurship. So I think we need to switch to this concept of innovation and a studio model if we want more innovation. And I also resonate with what David's saying. The other two things, being on the economic task force for the BC government, what I heard was there's a real lack of funding in the not-for-profit sector, and especially unrestricted funding. And I've been learning a lot about that through Tim Commode, which people will know in Victoria from Power to Be, and something he started called Power to Give. And what I've realized is there's an opportunity for our companies to provide top-line revenue to support the non-profit sector to kind of rinse, lather, repeat. And then the other one is really looking at the audit process around environmental and social sustainability. And I think that's our own value system, but it's also a trend, as David's pointed out. So we have a completely different model now, and it will be great for venture capitalists, because when we do get to that $5 million in revenue, we'll have a clean cap table and we'll have a really good management team and product team in place for them. But we're just trying to do things differently now, based on some of the findings that I heard traveling around the community, representing the province on that task force. So yeah, that was an interesting challenge for me when you answered that question, because I realized I feel like I'm in a different world now than what Annika and Owen are talking about, even though I come from that space.
I have a generic question for the panel. Is there anything that you think the government should be doing to help local economies that they're not currently doing, whether that be as micro as here in Victoria or provincially or nationally? Is there anything that you think that we should be talking about that we're not?
I can answer that question again too, since I was on the task force. So I think that we're doing a lot of the same stuff, and people are hoping that things will recover. And I think even the conference, the way this conference is designed, is part of that example. And I think we have to really look at new ways of doing things. So for example, there's a $500 million fund that the provincial government's working on right now. And they'll do what they've always done. They'll strike a board. It'll be political. They'll try and do their own investing. There's a great example in Manitoba of that. All the funds will actively pursue it, fund to fund. And so it's challenging, because we really have to look at that in a completely different way. And, you know, Dave, that guy from used to work in the Royal Bank in Toronto, he made a really good suggestion around creating more fund managers and then backing the ones that are successful. And I look at stuff like that and I think, yeah, there's lots of opportunity for us to approach this in a different way. I think economic development needs to look at the concept of attracting innovation and foreign entrepreneurs over companies. I think the money that we're deploying needs to be deployed in a different way. And I think the one thing the government could really do, if we are going to look at innovation in these areas, and again, I'm always talking about the pre-venture capital, so this isn't a criticism of the system we're in today. I'm just looking at it from a different lens. Is the back office service. So we have lots of opportunity to build these micro funds in all the communities, or in regions. I wouldn't suggest somebody did it in the community, but in a region. And I think the government could really offset that back office cost, and that would make a huge difference in the communities that are looking to stimulate new innovation, new jobs, and then the other one is really going after the idea of retail investment coming back into the country. I think that's the number one thing we should be working on right now.
How about you, Owen? I know you've had a lot of experience in the past dealing with government agencies. Is there anything that you think that they could be doing slightly better?
Yeah, I mean, I'm a strong advocate of government intervention. We spend a lot of, we give a lot of money to the government in taxes, and I'm a big fan of programs that are helpful. Certainly, driving innovation is good. I like supporting local fund managers, and I think a government program that would actually help build, venture capitalists, specifically in Victoria, because we don't have, we have angel investors. We don't really have a proper venture capital firm here. And the only way you do that is you help first-time funds get set up. And if the government is there to help, then that gives an opportunity to those people to build a track record, and then they can find investors to come along. The federal program, which was it started out as VCAP, and then the Liberal government changed it to Vicky. But that was a really good program that helped government dollars leverage a whole pile of private investment. It's not difficult to understand. The federal government takes is the first money in and the last money out, but they share the same terms as the commercial investors. But the commercial investors, again, are the last money in and the first money out. So it makes it a little bit more attractive to them. That was an excellent program. BC should think about doubling down on that somehow, or mimicking it. I would also say, we've got great programs to support R&D, but that doesn't help with customer acquisition. So, we all, use SR&ED credits and IRAP grants and all that kind of stuff. And that might be great at subsidizing, tech companies, but it doesn't actually help any of those companies be successful. It just provides a bit of capital to them. It reduces their costs because it doesn't help them with customers. What makes us more competitive is our ability to acquire customers. So I'd rather see, yes, it's great that we support our technology institutions and support R&D in general for innovation, but the innovation that matters is the innovation that leads to sales. University projects that don't go anywhere, don't help our economy, regardless of how much R&D money they soak up. R&D grants into companies that don't succeed, again, wasted dollars. So I'd rather see those kind of programs have some metric that involves, what leads to sales. So success and doubling down on grants, or doubling and tripling those grants in R&D because they demonstrated an increase in sales, I would far rather see. Difficult to do, but government has done it before. The BC government was a great leader when it came to the tax credit program for angel investors. That was a remarkably successful program and led to a great deal of new investment in new companies all across BC. So I'd love to see that continue. Government can do a lot of great things when they're well thought out programs. I just want to see them focused on successful business, not just subsidizing R&D.
Well, thanks, guys. I'm going to open up. We've had a bunch of questions submitted via the app, so I'm going to punt this out to you panelists, and you can all chime in as you see fit. A very popular theme, so to speak, in the last, especially 6 to 9 months, has been ESG funds, or investing with a purpose, whatever you want to call that. It's a very broad term, and it means different things to different people. But we've seen fund flows, for sure, really start to reflect investors' preferences, socially, politically, what have you. Now there's a new job, being the Chief Resilience Officer, becoming basically a norm. What signals do you think this is sending to traditional investors? David?
I'll jump in on that one. I think people are finally waking up and realizing that businesses that are run in pursuit of purpose as well as profit actually perform better on their financial metrics than the more traditional profit-only focused companies. And I think that the notion of that is starting to pick up. People are seeing that companies are more resilient and they perform better. And there's now global advocates for investing in this. I love the work that PRI is doing out of London. And so they have an initiative where they're inviting fund managers and fund owners to sign up to pledge a greater percentage of their investments in ESG investing. Last I saw, I think it was 2019, there was over $30 trillion that flowed into ESG investing. And I think that that's starting to happen. People are starting to see that it's the right place to put your money, that over the longer term, you're going to get a higher rate of return. You're going to have more resilient companies that are better able to deal with these short-term shocks that they're hit. And you'll be driving positive environmental and social change. So I think it's the future.
Annika, I have a question for you in the sense that when you're going, your firm and when they're going through their process, looking at what they're going to fund and what they're not, does ESG play a role at all for your decision making?
Yeah, absolutely. And, I would echo everything David said around this being a net positive for both investors and for companies, right? It's clear that companies perform better when, they're accounting for and taking care of all different stakeholders involved. And so I think this is sort of an excellent movement and kind of very timely and definitely something we take into consideration as part of our investment process. I think one very timely example of this, as I'm thinking back to the past week, is Airbnb's S1 came out in advance of them going public. And just reading through that and seeing how they articulate their company values, how they treat all of their different stakeholders, and how that has allowed them to build such a phenomenal business is a testament to their success. And I think we'll see more of this moving forward.
Thank you. Another question that came in was, how can we best attract retail investors from across Asia to invest in innovation right here in BC? I figured that would be like kind of right in your wheelhouse, Owen. You want to address that?
Sure. So we have Alacrity programs all over the world, including in China, and we start up companies all over the world. It did start here in Victoria, but we have programs in Mexico and France and UK and India, Turkey. So, we do business all over the place, and we see a lot of different interactions that generally involve how do you attract investment? So we say share investors, if you like, between the different regions that we know that are interested. One of the things that we do, we're a startup visa incubator, so we can attract basically entrepreneurs from other places into Canada, and that often comes with investment. So that has been one method which has seemed to work really, really well. The federal government set that up a few years ago. It's been a lot slower than we'd hoped. We originally promised 3 or 4 month process. In most cases, it's 2 years. So that sort of government grind has led to slowdowns, but it's brought millions of dollars of investment during our tenure as a startup visa incubator here in Victoria. You also have to understand the dynamics. There's a lot of challenges in retail investors, in particular from China. They have currency controls. They can't just say, well, we have lots of wealth, therefore we'll write a check. They have currency controls that prevent them writing checks into North America or anywhere else in the world, without special permission. So looking at a whole pile of people who might have lots of money, who can buy a house and a car, and they happen to come from mainland China, that's probably because they're allowed to, take money out of the country to buy a house and a car, but not necessarily to invest in a startup. So, there's different regulations that we've spoken to money managers, in mainland China who have, certain categories of qualifications to allow them to do that. There's certainly retail funds that are allowed to invest outside of China, but you can't just target them generally and say you should invest here. You have to understand who has the right qualifications and can take some of that capital and deploy it here. So it's more complicated than simply thinking it's a big pot of money that you can tap into. We've spent years doing that and have had some success, but recognize it's no easy solution. You have to understand who has the right to do it, who has access to the capital, and what forms you have to fill out and all that kind of stuff. It's not as straightforward as simply say North America to Europe. You can make an investment, you can transfer the money, you can do it. There's nothing preventing you doing that. That's not true at all from mainland China.
Okay, we had another great question come in. A K-shaped recovery means that many businesses and industries just will never recover. We keep hearing that we don't have a startup problem, but we have a scale up problem. What do the panelists think about pre-seed and seed stage funding? Without that innovation, it's going to be, without that innovation, is it going to be stifled in these troubled times? Peter, do you want to address that? Because I know that kind of talks about something that you spoke about earlier.
I'm curious what the rest of the group would say, so I'll pass on that.
Okay.
Well, I'll just speak to first round investment and say that it really depends, once again, on what segment of society you're talking to. Right? I was able to start my first company and take it all the way up and get it traded on the NASDAQ, but I was only able to do it because my mother's sister could loan us $8,000. And without that, I wouldn't have made it. I came from, a white privileged upbringing where I had access to friends and family money. There's a whole segment of entrepreneurs out there that don't come from that sort of background. And those entrepreneurs really struggle for the lack of friends and family money. What I've witnessed over the past 30 years that I've been semi-dealing with angels is angels are kind of backing away from being that replacement for friends and family money, and angels are wanting to see a little bit more traction, maybe some product market fit. They want you to get a little bit further down the road. That requires that very first round of funding. And I'm just finding that the entrepreneurs I work with really struggle with getting to what today is pre-seed and angel type funding. So there seems to be a hole in the capital stack.
Yeah, I would add to that and say that in British Columbia in particular, I think there's definitely a pre-seed and seed funding problem. There's definitely a gap there. Whereas if you go down to the valley, you look at some of the companies being funded at pre-seed and seed stages, there is more capital to be had. And I think some of it comes back to Canada and us just historically being a little bit more risk averse and this being new territory for us in some ways. Where I do have kind of, excitement and hope for the future and thinking about Vancouver Island in particular is we've got a lot of great startups and a good kind of bustling ecosystem to start off with. And as those companies grow and develop, you'll have more and more entrepreneurs coming out of there, angels coming out who have deeper pockets and who are able to help kind of build this ecosystem. And, as Owen said, there's also an opportunity for the government to step in here and help support pre-seed and seed stage funds to pop up, because we really don't have much in the way of institutionalized VC pre-seed and seed funds in BC.
And I think that, that speaks to what we've identified and what the problem we're trying to solve is that, typically angel investors look for entrepreneurs that have a proven business model that show the ability to scale to the venture space. And so that is a really big ask. And so my thought is that we really need to move towards this innovation business model to scale that early stage. And so de-risking it basically, because there's so much deal flow if you look at it from the IP innovation space. And not to say the entrepreneurs still don't play a role in that, but the way we're doing it now just doesn't work in Canada. It's a very, very Silicon Valley, model that I think we've been trying to copy, and I think that's done a disservice. So yeah, I think moving to the kind of a new way of doing it's going to unlock a lot of that.
Perfect. Well, we have time for one more question. This one is an interesting one. I'm sure there's a term I'm going to use here that many of these people on this conference call might not even remember, but the question comes, it says, I refer back to the Y2K for those old enough to remember that as being a bit, thankfully, a non-event. A lot of people pitched in and there were clearinghouses of available solutions. How might lessons learned from the Y2K help us with revitalizing and pivoting for today's businesses to help with COVID as well as their current businesses?
I mean, I was there. I started my first company a few years before that, and I remember Y2K as a non-event, and distinctly remember 2001 as a much more major event, which was the .com crash. Being somebody that was in the tech business, we were all aware of Y2K. But what really happened was when the markets reacted and the tech crash was way more substantial as an impact to us. That was a specific technical technical problem that lots of smart people had a specific thing that they could solve, and they had lots of time, and they built it up and they solved it, and it was a non-issue. COVID's different. It's a fundamental shift to the economy. Fear and risk was the same with Y2K, except midnight occurs and nothing happens. Whereas COVID is very, very real. Businesses, lots of small businesses are going under. Even big, good, solid businesses are really struggling and are absolutely deserving of government grants, because it wasn't their fault that they were forced to shut down and all their customers stay at home. They're very different. The fear might be similar, and the sort of ways people talk about solutions might be similar. But you could have ignored Y2K as long as you weren't a tech business, doing lots of transactions in with 2-year 2-digit years. But there's a fundamental shift in our economy and how we operate. And the funny thing with the economy is, regardless, you get winners and you get losers, right? If you're a hotel that's forced to shut down, that's not great. That's a real pain. And if you're an airline and nobody wants to fly, that's a real pain. If you're Amazon or you're Zoom, you're doing really, really well. And everybody in that category is doing really, really well. That's the real economy. There's always checks and balances, right? Money becomes cheap. People think, well, I can't afford houses. Well, suddenly you can't afford houses because interest rates are so low, the amount you effectively pay is lower. So there's, in the real world, there's checks and balances for all these things, and the proposed solutions to COVID challenges have to take into account that much more complex picture than the risk of everything stopping because someone forgot to change a 2-digit year. So I see them quite differently, and the solutions are way more complex. And you want a lot more, different offerings in the situation we're in now, because you're not sure what's going to work, and you're not sure what inspires confidence for people to continue to work. So yeah, I'd say they're very, very different, and we want a varied response to protect us in whatever happens in the future.
Well, we're coming up to about our time on this discussion. I wanted to thank all the panelists for their input. Obviously, this crisis has touched every single sector of the economy in way different ways. Some businesses are booming, some are collapsing. And I think that this discussion hopefully will help push forward the conversation of how businesses can be more resilient, both here locally and throughout Canada. I want to thank C-FAX, our sponsor, for helping us put on this event. Also RBC and Western Diversification Canada for supporting this.